Good afternoon, everyone. Welcome to this breakout session on settling legacy taxes. I'd like to introduce my colleague, Rosanna Paini, partner at our Italian associates, Arietti, Dr. Arietti and Associates, also a Mazars affiliated company from November, isn't it?
Yeah.
Rosanna will be giving a presentation sort of part way through. I'm Nick Hammond, and I'm an IPT specialist in the consulting part of FiscalReps. So, legacy taxes, well, I think we all know what we mean. Hopefully, historical premium taxes, usually, well, I would say almost always liabilities rather than any repayment. Occasionally they're legacy taxes in the true sense of the word, in terms of, they may be liabilities that you as an insurer have taken on through the acquisition of another insurance business, but often, more often than not, they're liabilities that perhaps your business has discovered, maybe because, for whatever reason, maybe you operate a diverse insurance group, and sometimes it does happen that parts of the group are not quite as joined up as sometimes they ought to be, and you might have had maybe IPT being dealt with locally by local branches, and perhaps not always with the necessary expertise. Or maybe, dare I say it, there hasn't always been maybe the necessary communication between the commercial arm of the business and maybe the people with the expertise, the IPT expertise in perhaps the finance function, and maybe business has been written which, without IPT oversight, and things get missed. Anyway, we won't dwell on that too much. How do we deal with them? Well, obviously in 45 minutes we're not really going to be doing anything other than kind of scraping the surface, but we're hoping that just by reference to some real life cases that we've had to deal with, that just to draw out some key observations, key principles that maybe you can take away and hopefully be of some assistance to you if and when you have IPT liabilities or historical IPT liabilities to have to deal with. So in a moment I'll just go through some preliminary matters that I think should be considered before perhaps going ahead and making any approach to the tax authorities. We'll look at a few kind of mini case studies, make some observations, draw out some principles. Then I'll pass over to Rosanna. Rosanna will kind of give a focus on how premium taxes can be settled in Italy and some of the key points there. And then at the end, I'll just kind of draw things together and just bring out, sort of sum up and bring out some of the points that we've discussed. The first session did go to time, so if you do want to interrupt with any questions as we go along, I think we can probably deal with that rather than leaving them to the end. But hopefully we'll have a bit of time at the end as well. So initial considerations, first things first. You as an insurer need to understand at an early stage what went wrong, because clearly if you have got unpaid premium tax liabilities, then something has gone slightly awry with your IPT compliance. There's nothing to be particularly afraid of. You just got to acknowledge that things don't always go 100% right. It's understanding what went wrong, what the circumstances are, because the tax authority is going to want to understand broadly the circumstances. Has it been put right? So if there's been some control issues with the IPT compliance, then have they been identified and corrective measures put in place? Because here again, the tax authorities are going to want to see some assurance that that those sort of issues have been adequately addressed. And then moving on to the data, checking the data. Well, it seems an obvious point, but what is the data? Is it taxes and premiums that you've collected? If you're looking at the taxes, then just by the fact that you've charged and collected them doesn't necessarily mean that they're correct. It might be that you've exempted some policies that perhaps were taxable, or likewise taxed some policies which may have been exempt, maybe in part or whole. So the data does need to be checked, and the calculations. And also, you need to look at the policy documentation and reconcile it to the data. Now, I'm not suggesting that if you've got hundreds of lines of business that you reconcile each line with the policy documentation, but it is necessary, certainly from our experience, tax authorities do require at least sample documentation. It is necessary at an early stage to reconcile that documentation to the data, perhaps on a sample basis, just to give yourself some assurance that the data has been properly extracted, it's robust, everything tallies. Because at the end of the day, you don't want to be in a situation discussing with a tax authority why the documentation you submitted with your voluntary disclosure doesn't marry up with the data, because that's immediately going to start alarm bells ringing in the ears of the tax authority. It's going to think, well, I'm faced with a business that's not really controlled for premium tax compliance, and that might then prompt them to undertake some sort of more detailed investigation, which you want to obviously avoid, because that's going to tie up lots of management time, and it could result in additional costs and additional penalties, etc. You need to understand also what the settlement procedure is, and that will vary from country to country. It might be a case of you need to correct the past premium tax returns for the periods in question. It might be well, it usually is the case that there'll be some kind of written submission that you need to prepare to the tax authority. Well, you need to understand what that is, because the detail will vary from country to country. There might, in fact, be a prescribed form that you need to complete as part of the process. So, obviously you need to understand the settlement procedure. Also, interest and penalty charges, they can be substantial. You should understand, you should do your own research in terms of what will be the likely outcome in terms of interest charges and penalties. In our experience, interest charges tend to be statutory. Quite often they're not discretionary, but penalty charges tends to be a different matter. They can often be quite discretionary, and under that discretion, tax authorities can, given favourable circumstances, even waive penalty charges altogether. So, leading on from that last point, is there scope for mitigation? And clearly, if there's a just discretionary element to some of these interest and or penalty charges, then there's scope for mitigation, and you need to understand how you can fall within that mitigation regime. Time limits. Certainly we find for most premium taxes there is some statutory time limit will exist. That may impact you because maybe possibly some of the tax in question may be technically time barred. If that is the case, then you need to consider whether you're going to take the position that the tax is not collectible, so you won't pay it, or whether perhaps you want to take maybe a more ethical line, perhaps, and take a commercial decision to pay the tax, given that perhaps you've collected it from your policyholder or policyholders, and it's just sitting on your balance sheet to be paid. So there might be a commercial decision to be taken in respect of any time-barred amounts. And then finally, but not least, you might want to sound out the tax authority in terms of the position that they would likely take in terms of your circumstances, particularly in regard to penalty charges, interest charges, and of course you can't easily do that maybe yourself as the insurer, but you can certainly do it through a third party on a no-name basis, just to get some comfort in terms of what you could be in for in terms of when you contact the tax authority. So just moving on to a few examples very quickly. I'm not going to go through the fact pattern, but you can read it at your leisure. But the first one was we assisted a US insurer in regard to settlement of some premium tax in Ireland. This was a kind of unusual situation because the policy shouldn't have been written from the US carrier. It should have been written from the client's UK-based insurer, but there was a fundamental mix-up as part of this, the global program. I think it was maybe a mistake on the part of the international brokers involved. But whatever the case, the business was written wrongly by an unauthorized insurer in the States. There was initially some concern on the part of the client that there might be some regulatory consequences if the central bank in Ireland, the regulator, decided that to take maybe some kind of legal proceedings against the insurer. But luckily that obstacle sort of was overcome, and the client came to us and said, well, can you settle these taxes for us? We advised the client to submit a qualifying voluntary disclosure to the Irish Revenue, and this is a written disclosure that fulfills the criteria, the prescribed criteria that the Revenue outline in their guidance. And this is a voluntary disclosure that has full particulars, the interest charge and the tax is paid at the same time as the submission of the voluntary disclosure, and the voluntary disclosure includes a declaration that the disclosure is accurate and complete. And in return for that, there's a lower penalty regime that applies. The Revenue undertake not to publish the tax default, and that could be a real benefit, particularly if you might have reputational issues, and in any case, no insurer wants to be wants it to be published to their peers and maybe to the public at large that they haven't paid their taxes. And then finally, the Revenue also undertake not to take any other proceedings. So even if, dare I say it, they suspected some deliberate evasion, on receipt of a qualifying disclosure, they undertake not to investigate any further with a view to any possible prosecution. So that's an added comfort if it was at all in doubt about the question of any evasion. So in this case, there was some interest to pay because that was statutory and not discretionary, but the penalties were mitigated right down from what could have been 40% on a prompted investigation, a tax audit, right down to 5%. So that's quite a good outcome. So just summing up on that case, a qualifying disclosure has several advantages, including mitigation of penalties. And that, you might think that's peculiar to Ireland. It's not, because similar kind of qualifying disclosures regimes exist in many other countries as well. The next slide is maybe a little bit closer to home, in as much as we were assisting an EU insurer. There'd been some kind of restructuring in the business, and as a result of that, it came to light that IPT in Germany and France and Italy hadn't been paid by two particular branches, which at that time had autonomy to deal with IPT compliance. It was since centralised in the UK business. But things have clearly gone wrong in the Spanish and Portuguese branches because there'd been some IPT oversight, and these historical German, French and Italian historical liabilities had built up. So we assisted in the usual way by reviewing and validating the data, estimating penalties, etc. But rather too late in the day, when reviewing a sample of the policy documentation, it was discovered that in a number of cases, the data didn't marry up with the documentation. And clearly that something had gone wrong in the extraction of the data, or it seemed that was the case. The client then had to revisit the data, and it was re-extracted. There had been some error, fundamental error had been made at the time of the original data compilation. So it was quite a bit of time delay, and we then sort of did our sort of validation and estimation, calculation of penalties and interest again. So in addition to the wasted time on part of FiscalReps as well as the client, there was the extra costs in terms of our fees were a little bit more than they might otherwise have been. But at the end of the day, the outcome for Germany and France was quite good, because there wasn't any interest or penalty charges assessed. Fortunately, I think that was probably the case because in this particular example, the insurance entity that had written the business in the first place had since been wound up, and the branch business passed to another entity in the group. That might have been the reason why no interest or penalties were assessed, but Italy is still pending at the moment. So it's just an obvious point to make there. As I said earlier, it is important that supporting documentation is reconciled with premium tax data at an early stage, at least on a sample basis if there's a lot of transactions. And then the next 4 slides actually cover what are normally regarded as policyholder taxes in the case of non-admitted insurance, which it was. But I think they illustrate a number of points which are directly relevant to not only policyholders paying the tax, but insurers as well. And the first slide was some taxes payable in New South Wales, Australia. And we did a bit of research and discovered that in New South Wales, there's a kind of 2-tier approach to interest charges. There's the kind of basic market rate interest charge, and then there's a punitive premium rate of interest as well, which can be applied. And the penalties could be anything up to, what have I got there? I can't remember what they could have been, but there were penalty, 25%, sorry. So we knew what potentially could be the worst case scenario on interest charges and penalties, but we wanted to find out what the tax authority's position was going to be before we made any formal declarations to them on a fully disclosed basis. So we did contact them on a no-name basis and got a really good outcome, because they agreed on receipt of the full information to waive the top rate of interest charge, the premium rate, and also waive the penalty. So there was just some market rate interest to pay. I say just because the figures were quite significant, but that was nevertheless a good outcome. So the point just to take away, I guess, is fairly straightforward. Research interest and penalty provisions beforehand. You might want to consider a no-name contact to the tax authority to just sound them out on their position in relation to any discretionary interest and penalties.
Can I just ask a question?
Yeah.
On this one, so the premium was paid to the insurer, not registered, and the insurer was liable. So in this instance, it's the insured that's going to pay all those charges because they hadn't paid it.
Yes.
What if the insured had paid the tax to the insurer incorrectly, and the insurer had kept hold of it and obviously not paid it over because they couldn't? Would the insured still then be liable?
Well, the insured would still technically be liable, yes. Of course, if they'd already paid the tax to the insurer, then I would say there's a discussion to be had there. In this particular case, it was a big global program, and it had been agreed up front between the policyholder and the insurers, because it was co-insurance, that the in a number of cases where the insurers were unlicensed in Australia, that the policyholder agreed to settle the taxes. So that was all discussed at an early stage in this particular case. But in the scenario you've just painted, clearly that's not a good situation to be in. I'm sure it happens. Yeah, I'm sure it happens. But technically, the policyholder is still on the hook in that scenario. Yeah, with an unlicensed insurers. Okay. The next slide I'm going to kind of go over quite quickly because it just illustrates a point that we've made already on voluntary disclosures. In Ontario, there's a similar regime as exists in many countries, like, for example, Ireland, where in return for a valid voluntary disclosure, you enter into a much more lenient regime when it comes to interest and penalties. And in this case, what could have been a 50% penalty was mitigated right down to 17%. So a valid voluntary disclosure clearly can avoid penalties. Moving to the US, again, it's a policyholder tax, self-procurement taxes levied by a number of states. In this case, it was for three particular cases, states rather. And we knew that in relation to self-procurement taxes, there has been quite a bit of litigation in this area, and on constitutional law principles, US states are limited in their ability to levy self-procurement taxes on policyholders in the situation where the transaction is an out-of-state transaction, in as much as everything happens outside of the state and the only nexus to the state is that there's a location of risk. So in those circumstances, these sort of taxes shouldn't really be applied, although we are aware that states take a slightly different view on it. As I say, there's case law. On the whole, it's pretty favourable if the fact pattern suits, i.e. it's a totally out-of-state transaction. But there's a little bit of uncertainty because, as I say, the states do take quite a tough line on it. So in this case, we facilitated for the client a legal opinion just to give them a little bit more comfort, and that was obtained through the associates we normally use in New York, Asher Harris. And that gave the client a bit more comfort, and as a result, they took the position that there wasn't any tax to pay. So I guess it's again, it's a straightforward principle to bring out. You know, if there is any case law that impacts on your case, then you need to be aware of it. If it's maybe not clear-cut, as this is not particularly clear-cut, you might consider taking an additional legal opinion just to give it a bit more certainty before you take a decision on whether to pay the tax or not. And then finally on FET, obviously here again, the IRS will typically go after the policyholder for any FET that's due rather than the foreign insurer. But nevertheless, it's important that the insurer is aware of circumstances in which FET can arise, because they should discuss it openly up front with the policyholder and agree agree who's going to pay the tax, if any is payable. So, and the point I'm just making there is, if the insurer and reinsurer, if there's a reinsurer, are they qualified residents, i.e. under a resident of a treaty country with a relevant closing agreement, so there's exemption. If not, then FET could be payable and have arrangements been made for who's going to pay the tax. So that's kind of me finished for the moment. I'll come back and kind of sum up at the end, and it's over to Rosanna.
Okay.
I hope I've left you enough time.
Thank you, yes.
Yeah.
Thank you, Nick. And thank you for...
I'll just stick around because I'm the guy with the mic.
Yes, sure.
I've got the
He's
microphone.
The guy with the microphone, so I need him. Okay, and thank you for coming to this session. So, before presenting my case, let me introduce the tax framework in Italy. IPT is and should be a simple tax. There is a tax base, there is a rate, and there is the IPT. But even in the simplest context, there are exceptions, and exceptions should be regulated. And what exactly we miss in Italy is the regulation of exceptions. And why? In Italy, the number of the insurance companies is well below the number of the insurance companies in the UK. And therefore, because the number of the insurance companies is limited, is also limited the number of cases requesting clarifications and the number of way for the law to change. So because there is no cases that need clarification, the law is not, the IPT law didn't develop, and you know that is a law that is dated back from 1961. So, in Italy, because of the lack of this clarification, we have no IPT audit, we haven't had no IPT litigation cases, and this is where we are. Maybe you will be surprised to know that since 1991 we have been in Italy only 5 IPT litigation cases, so in more than 25 years. And you will also be surprised to know that there were no specific team dedicated to IPT within the tax office until January 2013. Now there is a specific team, and the tax office is trying to build skills on it, but this is a work in progress. It's not done yet. So definitely it's not such a bad news not to have an IPT legislation development if this is a consequence of not having IPT audit and not having IPT litigation cases. But it could be a problem when you have yourself a problem and you need to find a solution within the law. And this is exactly our case today, because the current law does not regulate the settlement of previous year tax liability. In Italy, the voluntary disclosure is regulated only if the voluntary disclosures occurs within 3 months for missed submission or within 12 months for wrong submission. In this case, penalties are automatically reduced down to 1/8. But this law is a law that is regulating VAT and direct taxes. It's not regulating IPT. It was a tax office that, with a circular letter recognizing the possibility to use the general term of this law also for settling liability for IPT. What does a general terms mean? It means that the procedure is the same, but the statute of limitation and the penalties are different from VAT and direct taxes and IPT. So the statute of limitation for VAT and direct taxes here is 4 years, whereas it is 10 years for IPT. Penalties for missubmission are lower for IPT than for VAT and direct taxes, but penalties for wrong submission are much higher, the double. Fortunately, a mistake for IPT in the IPT behavior does not have criminal impact, whereas it is the case for VAT and direct taxes under certain circumstances. So, In this context, we were contacted last year from an insurance company to settle historical liabilities for the period 2003 and 2010, so a period that was not covered by the law for voluntary disclosure. This company, for a problem in their internal system, didn't declare the IPT on contracts taken out outside Italy. They only declared IPT on contracts taken out from the Italian brokers. The overlapping of what they have declared and what they have not declared brought us to consider disclosing missed submission, wrong submissions, and underpayment. And this in a context where there is no law regulating the case. What did we do? First thing, we work on penalties scenarios. As there is no specific law, we tried to figure out what could be the end and the risk for the client. Then we tried to open a communication with the tax office. We first approached the tax office that was in charge of the freedom of insurance company, the insurance company acting under freedom of services regime, but they were surprised and they didn't know how to deal with it. But fortunately, we found somebody that was interested within the central tax office. And we were lucky because in the central tax office, people can take responsibilities and decisions. That is not always the case in the local tax office. They were interested to our case for two reasons. First, because we were presenting a case with no precedent. And second, because this specific case had a big financial impact. We started discussion with them first on a no-name basis. But then after a few meetings, we create a mutual trust, and so we disclose the name, we present the document, and we found a solution that was suitable for the client and for the tax office, and surprisingly, within the tax legislation framework, even if there was no law regulating the case. So the procedure was the procedure classic, the same as disclosed by Nick before. So data collection, very important to know that all the data are accurate and complete. We need to check that the data that are listing, that are presenting, check with the contract, that the tax point is correct, that the tax base is correct. Then we have to draft the IPT book if they do not exist, as sometimes they do not exist. Then we need to find out how to provide the office with the evidence that what we are disclosing is exactly all what the company has cashed, because they can ask for it. Then we can make a final estimate of penalties and interest applicable, and we are ready to go to the tax office with all documentation. And they take the time to check the documents, and at the end, they write the final document to be signed by the client, and that define the amount of taxes, interest, and penalties to pay. So how we could reach an agreement within the law if no law is regulating the case? Because we simulated a tax assessment, a tax audit. So when there is a tax assessment, the taxpayer can agree with the outcome of the assessment, and then is granted a reduction of penalties down to 1/6 in the case of missed and wrong submission, and down to 1/3 in case of underpayment. But then, where is the deal for the client? Because he can get the same reduction sitting and waiting that the tax office go and make the audit. And in fact, our discussion with the tax office and the fact of presenting a case brought us to have a further reduction of penalties, down to 1/12. Why we could have that? Because there is a law in Italy that aims to protect the taxpayer when there is a disproportion between the mistake and the tax burden. In this case, the disproportion was mainly because of 200 to 400% of wrong submission that is unusual in the Italian tax framework. So we get this reduction. The total granted reduction that a tax officer, the maximum reduction that a tax officer can grant, so down to 50% for missed and wrong submission, and we got no penalties for underpayment. So this proves that if we are in good faith and we are ready to disclose everything to the tax office, we can find solution even in the absence of a specific law. And this is a very success story because we have got a reduction of penalties, very important, down to 1/12. We have established a good relationship with the tax office, and we set up a sort of unwritten procedure that we are using now to settle liabilities, tax liabilities of previous year, also for other clients. So we are in a good position to help. Now everybody has a problem for previous year tax liability. Thank you.
Sarah,
Yes.
can I just, because as you know, I work for the association, so I see the overall system of the IPT. I've done it for years and years, but of course I miss the operational and litigation issues. It's very interesting because you told me that you had the right contacts with the tax administration. What if these right contacts would disappear in the future? So,
good question.
I put it in another way.
question.
Since you properly reminded, you have been successful in generating the reciprocal trust. And this is, of course, on a personal relationship.
Mm-hmm.
But since I know many people in the tax administration, in the central tax administration, I know that sometimes not all the staff is in touch with all details of previous cases. Should you go once again within 2 years to represent a similar case, would you think it would be
successful again
as well?
Well, this is a good question. In fact, our contact with the Central Tax Office triggered the restructuring of the office. So it was following our request that the Central Office felt the need to create a specific team focused on IPT for insurance company acting in freedom of services activity. And this was meant to be established at the regional office at Rome. You know, before it was not at the regional office. They also gave direction to the people in this office, to the team, let's say the IPT team, to behave in that way and grant the reduction if certain conditions are met. What are these conditions? When a company like a company acting in freedom of services want to disclose something, it's much easier for the tax office to receive what the client what the taxpayer has to disclose instead of trying to look for him, because it is broad, it's difficult, because an insurance company in freedom of services can declare something this month, nothing for 2 months, and then again. So there is not such a regularity or something that they can check just going in a branch or in a national company. So they have to act to start an international procedure. It is difficult for them. That's why they decided in this case to grant this reduction down to 50%. And so far, the people is the same.
Okay.
And we are pretty sure that under certain conditions we can get this discount. But I agree with you that within 2 years, if people is not longer, the team is not longer the same, the head of office is maybe no longer the same, I'm not sure that we can get this, unless we keep continuing disclosing, and so we create an history.
The thing is that in Italy, this is what we call Cinderella tax, because it's something
exactly.
almost for but it is also a tax which grants 6-7 billions per year of tax yield. So
without many work.
No, at all.
Very efficient.
Without many work. Yes. So Alessandro is a tax responsible in the Italian Association of the Insurance Companies. Alessandro Longo, for who doesn't know him. Any question?
Hopefully now it's going to be a team, so if somebody leaves, the other one will know the process.
Hopefully. Yeah. Okay, I leave you, Nick, to...
Fine. Well, just this final slide was just to recap really some of the points that we made earlier. At an early stage, it's important to ensure that the data is reliable, supported by the documents. You need to understand how the liabilities arose in the first place and be able to demonstrate that any control issues have been sorted out. An initial approach to the tax authority obviously can reap dividends, as Rosanna can demonstrate, and as we know from other cases we've dealt with. There might be some relevant case law that impacts on your circumstances. FET, if it's payable, then what arrangements have been agreed? What do I need to do as an insurer to mitigate interest and penalties? And well, we've been talking about this constantly, really, in terms of usually the case is some form of written voluntary disclosure that comes within the any discretionary application of penalties and interest. And of course, Rosanna also mentioned that in some cases it's good to have some evidence that you can demonstrate to the tax authority that what you're submitting is complete and accurate. And we talked about an internal audit certificate is sometimes good to have. And that's it.